Hello, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Today, we are looking at, once again, some measured moves up, some measured moves down. That is the title of today's post. Some very interesting things potentially going on in the background while we are still within this upward bull trend. Some interesting questions, of course, surfaced during this. What exactly is causing our move up? Do we have some interesting catalysts potentially around the corner? All of this definitely interesting to think about, but certainly on a day-to-day basis, does all this excitement necessarily mean that we are just heading into the stratosphere automatically, right? So during yesterday's write-up, yesterday's video, I talked about how really into the end of December and into early January in 2020 and 2021, when GameStop went into this huge upward volatility event, that it still took some time for multiple factors to compound upon themselves in order to produce that type of exponential upward movement. For months, we had lots of upward momentum that was nonetheless still technically bound. It was still controlled within expected trading ranges. And that's really what we're still looking at here. Now, it doesn't mean moves are not being made in the background. It doesn't mean, for example, that insiders are not accumulating right now. It doesn't mean that there are not catalysts around the corner. We still have sort of this idea of maybe Roaring Kitty symbolically gesturing to some important dates, gesturing to dates that say rhyme with key events from the 2020-2021 GameStop upward movement. We have, say, the rhyming date of something like December 21st, when Ryan Cohen released his amended 13D, having increased his position by 30% following Q3 earnings report. We also have coming up January 10th as an important date. In fact, it wasn't until January 10th, after several catalysts in December had kind of compounded on themselves, that the January 10th catalyst really kind of kicked off this exponential move. So if we are looking at this kind of beat for beat requel, something very similar to at least the timing or the structure of that type of move, we might have some time left to wait on that. And in terms of looking at our options data, looking at our technicals, it does still look like we are in some tightly bounded, paradigmatic trading moves. We're looking at that kind of price action right now. Now it's bullish, right? It looks good. It looks good for the near future. Certainly the past 2 weeks, we had, right, the catalyst of Roaring Kitty's tweet on the 5th of December, and then the earnings catalyst on the 11th of December. Very good stuff that kept our bull channel intact, that kept our upward trend intact. So I would say, overall, heading into digesting our data, I would say something like, keep in mind that within a technical paradigm, there are ebbs and flows. We are currently ebbing or flowing, perhaps. No, we would be flowing. This would not be an ebb. We would currently be flowing. We may be flowing right now, flowing yesterday, something like that. But even within these technical paradigms, we do have some predictable ebbs. So as we look at our data, I would encourage us to keep these types of patterns in mind, right? Of course, this is not financial advice. This is not a solicitation for you to invest in GameStop. This is not a solicitation for you to trade GameStop. But if you are trying to understand our price movement or anticipate our price movement in the near future, it is generally a good idea to keep these principles in mind. I certainly remind myself of this when I am thinking about my investment, when I'm thinking about the way that I'm going to trade GameStop. So yeah, so let's get right into it. Let's take a look here. There it is, measured moves up, measured moves down. Before we hop into our data though, I do want to point out something that I think is very useful for anyone who is interested in understanding maybe what are some of those catalysts, what the relationship or relationships are between these catalysts, maybe that we point out to, or our day-to-day price action, and some of the deeper structural elements that are playing out behind the scenes. There is a user otherwise category 42. So Reddit user otherwise category 42 and Twitter user otherwise category @other category 42 has gone ahead and posted a substantial due diligence an attempt to analyze some of these factors, combining understandings of regulation extension code 68068, thinking about the requirements that have to do with filing for an extension when you're margin called, when an institution is margin called, thinking about fail to deliver settlement cycles and their relationship to FTD, I should say, to ETF creation orders, the relationships of these and potentially how these may relate to some of our more unpredictable or dynamic price action and how some of that might correspond to symbolic communication between Roaring Kitty and Ryan Cohen, certainly over the past 3 to 4 years. So I would highly recommend you check this out, at the very least, just to see the type of thought, to the type of investigation or thinking or concepts that are necessary to digest in order to really get a sense of what's going on in the background, right? A lot of what I talk about here with open interest tends to be day-to-day stuff, right? And some of it is even symbolic in and of itself, or representative of something that's going on behind the scenes, right? It's attempting to gain insight from certain indicators that in and of themselves do not display something mechanical, but that gesture as a first or second derivative to something going on that actually is mechanically causal behind the scenes. So otherwise, category has done a really great job with this. I definitely recommend you go take a look at it. It is also neither trading advice nor financial investment advice. So do have a look at that. It's going to be linked down in the description of this video if you're looking at it on YouTube. And of course, I did go ahead and post this in several areas on my Twitter, on my X profile yesterday. So go ahead and give this a look. I think I'm going to give this a little bit of a deeper look together. We can read through this during this week's live stream, which is going to be after market close on Friday. So look for that announcement on X and the posting of it on YouTube as well. It's going to be hosted on YouTube. So yes. So yesterday, yeah, we did get some really excellent bullish momentum. What I will say, as I echoed here, as I iterated here in today's article, this really struck me as mostly an options directed move. Now, maybe we did have some buying going on in the background. Maybe insiders are accumulating shares here. Maybe a part of this was a reaction to some of that was going on yesterday. It's hard to say. Yesterday, I should say Monday's price action did look like it was driven at first. There was something of a buying catalyst that took place not primarily in the options market, did not originate in a dark pool, and was not anything certainly that Unusual Whales was able to pick up on lit whale trades. So therefore, I don't know where that buying pressure come from. It could have been insiders buying. It could have been something like shorts covering, right? Not legacy shorts, but shorts maybe back from around Thanksgiving, maybe just after Thanksgiving, maybe shorts who entered when they thought we were really going to shoot out of that upward bull channel back around the time of Roaring Kitty's tweet. I'm not sure. Some sort of buying event that had to do with that looks to have occurred prior to the beginning of our run on Monday, in the final hours of Monday that I spoke about in yesterday's price movement recap discussion. So yesterday's trading opened with some really dynamic moves up into just about that extent of our, what would I say, our primary call gamma dominant trading range. So if you recall, just above 31, I said, okay, we could get into the, into this 30, 31, 32 area, but because we don't have a lot of call open interest, therefore we don't have a lot of call gamma exposure for market makers at around 31.50. We didn't have it at 32.50. We had it at whole dollar strike, so 32 and 33. But really, because of that, we didn't have that kind of continuous pull from from sort of densely packed call gamma exposure, right? So we don't have that same level of kind of hedging support. We reach this kind of dead zone, and then orders are just kind of happening in this kind of gap. And whenever we have that, right, whenever we see momentum kind of fall off, we see call sentiment flow reverse. We'll see options flow sentiment reverse, since moving up a gamma ramp, moving up and through very call gamma exposure dominant positions has the effect of really ramping up IV, really sort of accelerating the rate at which calls appreciate in their value due to their change in gamma, their change in delta, right? Gamma measuring change in delta. So, really, if you're trading calls, if you're an institution now, not necessarily telling you to go out and do this. These are very difficult to manage. It's extremely easy in order to mess up single leg long call trades. They are structured in favor of the dealers. So, I would really not recommend it unless you have a lot of practice, a lot of experience with these types of trades. I myself have made plenty of mistakes with this, and trade single leg long calls are very, very rarely, only in the best circumstances. It's very easy to make a mistake. It's very easy to be wrong. So ideally, if you are trading this trade, if you are trying to do this upward momentum trade, right, you want to enter at a point and then exit at a point where sort of acceleration is still in your favor. And when you start to see that momentum fade, that's when you hot potato it out. Because if you're trading that, right, you're trying to think, okay, right, I'm in here, right, I want this to appreciate, but also I need to be able to get out, because as fast as this goes up, it can also come down very fast. And when that happens, the price will change very quickly. Right, the valuation on especially short-dated long call options, like a lot of what was traded yesterday, especially if they're close or near, out of the money, a lot of their value, most of their value is extrinsic value, meaning it is based on potential value in the future. And very small changes, right, change in direction, change even at the rate of ascent, the rate at which the price is ascending can change the value of an out-of-the-money near-dated options contract, especially a call, very dramatically. Okay, so, right, we see this kind of seesawing effect here in the price as sort of momentum slows. We get maybe near one of these critical areas. We slow down. We get towards this hedging kind of dead zone, and then everybody who did this trade is basically starting to exit en masse so that they can take some profits, because they don't want to be the last one holding the bag, and then reposition, and then send it back up, and then so we see this kind of seesawing effect. And while this was going on, right, we have the 50-minute simple moving average established as a kind of threshold here, some targets for some we have kind of reversal points targeted at places where this average kind of has a confluence with other technical indicators. But okay, this was our price action early. We had some time, right, while call momentum was still there, while we had this kind of euphoria, and maybe retail sentiment was very heavily in there. Right, we just kind of ran out of momentum. We did have 3150 fill in on these shots up to 3150. We did get enough call OI to kind of fill in at 3150, such that each successive shot up was able to fill in this kind of gap to press a little bit higher. But really, we got close to 32 once this attempt up did not surpass 3188. The writing was kind of in the wall that we were going to reverse back down to. I think I even mentioned this in some comments yesterday, that we were going to reverse back down to 30. Bounced off the call wall at 30. Sort of had this lineup here of what was formerly our bearish channel, and now looks like a sort of a range-bound channel beneath us. And we ended up trading around VWAP, the coincidence of VWAP and this 200-minute moving average. Somebody tried to push it down right back to this support line, back to the midline of our bullish regression channel, and then this kind of set up a reversal trade into the close. So certainly an interesting day, right? I mean, lots of potential, lots of very profitable intraday type moves for day traders. Obviously, really difficult to do this. It takes a lot of practice. I really don't do too much intraday stuff. Even myself, my trading style is not super active. I do obviously take these types of things into account when I'm looking at week or multi-week entries for maybe trades that I'm going to make. But that's right. I'm not. It's very easy to mess that up. I'll say that. Right. Okay. So some interesting price action, but does this necessarily mean that we were gonna go higher? Does that look like what we were set up to do today? Right. I mean, I understand. I'm making this video a little bit after open today. So yeah, we basically saw what I projected here in the article. So right from our technical setup pre-market, what this looks like to me, right? We're very clearly within this channel, and the boundaries of this channel have been navigated pretty thoroughly now. They've been negotiated, respected, right? Attempts to exit this channel have been really strongly rejected. So yes, it looks right. We made a higher high yesterday. It looks like, right, if this is gonna go up, I guess there might be still. It's around 12 p.m. Eastern time. Today is around the time I'm recording this video. If we go over and we look, say, at our intraday price action now, right, we can see this. We can see this live. Let's take a look over on Thinkorswim. Right. So, if we zoom out here, yeah, look, we look like we're trading kind of in this range bound kind of area, in this, above the midline of our bullish regression channel, kind of right on top of it, right? We traded down, we hung out right on that line, right? We kind of bounced back and forth around that line. Looks like something got picked up here early on. What was very interesting, I would say, is that I noticed a very similar type of move happened at exactly the same time on AMC. And let's see, did something happen on Chewy too? No, just AMC. What's very interesting to me, right, I won't go into too much of this. I won't speculate too much on this, but certainly, and this is something suggested, Richard Newton's talked about this a bit, well, actually quite a lot in many of his videos, but a bit recently. And Otherwise category does talk about this a bit, and that's the concept of ETF creation orders and sort of basket stocks. So the idea that GME is a stock in a basket of other retail stocks, and that part of the way that funds or institutions settle fail to delivers is that rather than outright failing to deliver the stock in question, because they've kind of stopped doing that with GameStop for a while, such that GameStop not go on Reg Show, which would end up, for a number of reasons, this would potentially put some of their portfolios in jeopardy. So what they tend to do is they tend to say, okay, well, I don't want to fail to deliver GameStop exactly, so right, I'm going to go and do this ETF creation order. So I'm actually going to settle my GameStop trade. I'm going to settle my GameStop FTD with an ETF creation order. So I'm going to go out to something like XRT, and right, which is the SPY retail index, and have a number of shares created for me. And I'm going to go and I'm going to short shares of this. Right, I'm going to satisfy my I'm going to satisfy my obligation to GameStop by borrowing a share of this and kind of failing to deliver this ETF, and that's going to make things more for whatever reason, this is going to work out better for me, such that I not be put on the hook for shares of GameStop directly because of one reason or another. Maybe I'm a legacy short and I just don't want to poke that bear, something like that, or I have a swap and I don't want to mess with that, right? But so it's more convenient for me to do it as an ETF. So when these ETF shares, these created shares, are then redeemed by the ETF, right? They're borrowed, they settle component trades of this particular basket of stocks, and then they're returned. What will happen is there'll be a covering event that will affect all of the stocks or many of the stocks, whatever is in this custom basket, they're going to run in similar ways. So if you have a particularly large fund, say that, I don't know, maybe they had a creation order where they shorted 300,000 shares of XRT, right? So each of the stocks that they had in their custom ETF, right, their XRT basket, then when they go and return that, you're going to see a buying pattern that's going to mimic that across a number of different stocks. So like something like that absolutely happened in the sneeze in 2021. So that's why all of these different stocks ran at the same time and ran in similar patterns to GameStop. So something like that seems like it may have been happening today on this particular move, because on AMC, yeah, we got a similar type of move basically at the same time. So AMC traded down, and then let's see, this candle on AMC, around 4:38 p.m. Excuse me, around 10:38 a.m. Eastern time, and then we got something similar. Yeah, this same candle, basically around that time, right? This got picked up pretty much around that time. So, and then we've been trading, rather than trade in the lower half of our daily sort of VWAP split here. All right, so we have our VWAP channels. Rather than trading in the lower half of the VWAP channel after 10:38 a.m., we've just been trading in the upper half of our kind of newly explored VWAP channel here. So very range bound, and that's more or less what I talked about in our options data, in our gamma exposure data, I should say, which is a form of options data. So if we go over and take a look at that, we'll see that, yeah, we had a nice distribution of, is this what I want here? Yeah, this is what I want, I think. Yeah. So if we go take a look at our gamma exposure data, right, obviously still trading in this area, right? We're at a 1 to 5 put to call gamma ratio. This projects more stable trading in these upper ranges, does not forecast price collapse anytime soon. And right, in general, our proximal strikes have gotten a lot greener, meaning more heavily biased towards calls. That's an accumulation of call gamma, meaning stable trading, I should say, right? And it's shifted up, right? So we were looking at a bit more of a concentration of call gamma lower. Obviously, as we've moved farther away from these prices, the gamma hedging is not as strong, right? So even though there could be a lot of calls there, gamma hedging is not as strong because most of that delta has been realized, or I should say that potential for rapid change in delta has been realized, right? Gamma measures the rate of change of delta. So that is the rate of change of the value of an options contract per dollar of appreciation or depreciation in the underlying stock that options contract matches to. So when you sort of go really in the money with a specific position, right? Even though we have a fair number of contracts, say at 28, we might not be seeing as much gamma at that position because the gamma value will be lower because it's now pretty decently in the money with us trading here up around 31 or 31.50. The rate of change of delta is relatively low because the delta on that contract is much higher. There's not so much, right? The max delta you can get on an options contract is 1, so that it appreciates by $1 or depreciates by $1 for every dollar that the underlying appreciates or depreciates. So, if the delta is, 85, right, 0.85 on an options contract, the gamma value is not going to be very large because the rate of change of delta, if the price keeps going up, is only something like, it's only going to go up a couple tenths of a point of delta per dollar. So the gamma value is going to be low. It means that the gamma hedging with respect to that position, most of the gamma hedging that pertains to the calls at that position have already been actualized. It's not potential, right? Gamma is often measuring the potential for change, for rapid change in delta. And that delta change in terms of the appreciation of the price of the underlying has been realized. So that hedging that accompanies that price movement, that theoretical price movement, has already happened. It's already been realized. Those hedges are now being held. They're no longer sort of pertinent to this potential gamma value. The market maker, the dealer, is now holding hedges in order to cover right, cover that position to remain delta neutral. So, right, so we see some of these in the money contracts, right, their delta values go down, and we shift up, or I should say their gamma values go down. Their delta values are up, so their gamma values are down. And we have a higher concentration of gamma up here. And we're looking actually a lot closer to what we did, say, going into Thanksgiving. So that Tuesday of Thanksgiving, right, we had a huge big up day. We went to, I think, like 32.12. We had kind of a sideways day, but still in these upper 30s on Wednesday of Thanksgiving. So that would be the 27th of November, so 26th, 27th. Thanksgiving was on the 28th, and then we had this half day on the 29th. And we traded all the way down. We had a ton of shorting, right? There was a ton of likely ETF creation. So creating lendable shares to borrow, that sort of popped out of nowhere. I think we got up to, into the 2 millions available, and we saw, at least 1 million, probably more than 1 million shares shorted on that half day, those 4 hours of trading, 3.5 hours of trading on November 29th. And then we got another dose of 1.4 million shares on the Monday following. So that would be the 2nd of December. So a ton of short volume. We even saw some short volume later in the week. So we're actually looking in terms of our option structure a lot like that, where we have this accumulation of gamma up above, right? I mean, now 31 is in the money, 32 out of the money, but still a decent amount of gamma accumulation there. And you might say, okay, so, well, does this mean we just go up? Like, you can kind of see that up above 33, we don't have that same level of gamma accumulation. We don't have it, right? It's very thick. It's concentrated here. We kind of run out at 32.50 as well. Not a super strong net position. I mean, if it could fill in a bit there, yeah, we can run through that. If we get some bigger volume, say in the second half of today, or I don't know, early tomorrow or something. But basically, right, we need some kind of event. We'd need some sort of catalyst or, an intention to kind of push the price up in order to really kind of get up there. But once we get there, if we don't have this sort of sustained momentum, if we don't have a reason for the options market to continue buying, or we don't have, say, insiders going and picking up hundreds of thousands of shares, it's not going to sustain. And if we hang out around a certain level and it doesn't sustain, it's going to be like what we saw kind of leading up. Every time we got to a new price level, sort of a new high, right, in our run here, right, we move up. Okay, cool. All right, we're up above the resistance line. Very cool. And then, but we don't have too much gamma accumulation up in this. So reverse. Okay, reverse. Trade down here, consolidate, but kind of go up, and we get these little runs, and then boom, big pop. And then, oh, wow, we're way outside of our technical bounds now. We're outside of our bullish regression channel. We don't have any gamma up here, right? It's at 30, but not enough between, say, 27 or 28 and 30. So then we trade back down, we consolidate, we sort of trade in here where there are options. We can bounce this back and forth. It's stable. It's not super, we don't have a lot of volatility. We bounce around, and then we make another go, and then come back down and make another go, right? And part of this is there isn't a continuity of the ramp. So it's got to move, right? You think about it like a flow. Options is always talked about in terms of a flow. They move, right? The price has to go somewhere. If it's not moving up, it's moving down, especially on an active stock like this, like GameStop. Too much potential to move this thing around. Too much in the terms of options activity. Like, somebody's going to be doing something. Somebody's going to be trading options to some extent. Sure, it has its days where it kind of goes sideways, but that's what's going to happen. And if you don't have some major external catalyst, or you don't have a distribution or an accumulation of, say, call gamma up above where your current price is, then there's not going to be too much confidence to use options to influence market maker hedging, to bring the price up into that range, because other traders are going to be waiting for you to do that so that they can immediately go bearish and then push you back down just as fast as you got up there. If you don't have this hedging support sort of muting directionality, sort of muting the rate of movement between certain strikes, right? You'll notice the price will move faster between key strikes because there is less call gamma accumulated there. So what it does is it can kind of act as a magnet as you move toward it. So gamma hedging kind of propels you towards that. But then when that gamma hedging is realized, the gamma then sort of can pull back in the other direction if you get momentum. And once it sort of hits a dead zone, then there's nothing kind of holding it in place there, right? You're not being counteracted from what's above or below you at that point. So it's easier, it's less risky. You risk less capital as a trader by betting on a reversal rather than betting on a continuation based on that type of setup. So right, I've been pretty wary about looking at another week with a close below $30. We have not done that, as I've mentioned, since August 2022. We got an RSI signal, right? We got an RSI overbought signal yesterday. That's a strong signal for at least consolidation, if not outright reversal. And yeah, for now, we're not really moving. We're not really moving outside of the bounds of kind of this 3150 area and 31, right? We're actually trading in a pretty tight range, which yeah, is what I wrote up in the article here. And, like once again, taking a look at the chart from 2020 into early 2021, that's what we were doing here. Rather than on the 4-hour chart, we were primarily being guided by a paradigm on the 1-day chart. And we made basically this move, bearish channel transformed into something range bound around earnings. And then as it became range bound, right, boop, little pop right out there, which happened yesterday. We finally transformed into a absolutely flat channel. Flat regression channel, I should say. And yeah, popped out here. Maybe we, there's still time today. Maybe we still go up and we test kind of resistance up at 33. But because we're still so technically bounded, because we're not seeing any really clear big news, company news, catalyst, anything like that, if we do go up to 33, I'm still expecting that we retrace back to the downside to something around 30. Maybe we don't do sub 30. Maybe it's something like $30.15. We're close enough to 30 now. We could trade down tomorrow back to on the top of the call wall, and then at on Friday open, we get a little play around the call wall, and then traders come in. An institution throws a couple 100,000 shares of shorting, and traders kind of ride that. They open some bearish bets, and then we get some charm as out of the money options die, their delta values die. Dealers sell those hedges for those out of the money calls up the chain, and then who knows? Then we're trading. Then we're closing below $30 again. So Max Payne still sitting down around $26. Might move right. I think early in the week I said we'd probably head up to about 2650 is about where I think the highest we'd get. Okay, because we're really trading so heavily, like our OI is so heavily in favor of calls right now. Yeah, look at this too. When we open today, almost exactly half of our calls are in the money. That's very atypical. That's certainly atypical for a very technical move, a technically bounded move, and not something that's driven by an unexpected catalyst. Okay, so something like this, yeah, just makes me think, all right, dealers are typically looking at like 85 to 90% of the calls that they sell closing out of the money. Right, last week we had in excess of 90% of all of the open calls closing out of the money. So, I would not be surprised that we saw something at least closer to that, but not having 50% of the calls close in the money. I've seen dealers pull shenanigans a lot of times, and I would not be surprised to see something similar in that case. So, yeah, I mean, without really, hitting this over the head, definitely go check out this DD. Very cool. There's otherwise put a lot of work into this. I know he's been working on this since his pretty cool cost DD that came out. His thoughts on costs back in July. If you were there for that, the cost case or something like that. I forgot what he called it. But anyway, definitely go check that out. Highly recommend it. Give him a follow too. Every once in a while, right? He's not a super frequent poster, but his stuff is quality. So I'd definitely recommend that. Even just to be able to go through the thought exercise here is certainly useful. A lot of great information there. A lot of great links. It's a very well designed, and it's fun to read too. He put a lot of work into the visuals. of this particular doc. So I definitely recommend that. Yeah. So, I mean, still, the great news here is bull trend intact. We might get some news from the company, right? We might get some news that potentially insiders bought over the weekend. We might hear something on Monday, the 23rd, in terms of maybe something like a rhyming date with Ryan Cohen announcing that he had expanded his position. Maybe we see something like that. I don't know. Certainly interesting to think about. We are, in general, doesn't look like we're showing any signs of this bull trend running out of steam, especially insofar as we got these two catalysts that saved us, both Roaring Kitty's tweet on December 5th and Ryan Cohen's announcement that the company would not offer any additional shares, any at-the-market offerings this quarter. Does not anticipate doing that. So yeah, looking forward to something like that over the weekend. Looking forward to maybe something like a bigger catalyst on, this January 10th window. I think January 10th this year is a Friday. Let me see. It's a Friday, so maybe something after hours, something like that, something unexpected, maybe during the day, and then the following week maybe something happens. Who knows? Otherwise, has also done some good thinking on this. So yeah, check it out. Make sure you. As always, do your own research with this stuff. Yeah, I'll be jumping into some more of this, some more of Otherwise's fine work, I think, during the stream on Friday. But hey, enjoy this trading environment while it lasts for those of you that are trading. As always, thank you very much for watching and listening. Look forward to seeing you all tomorrow, and look forward to seeing what the next few days have to bring to us. So thanks very much. We'll see you next time.